we're in for a decade of good semiconductor industry characteristics because every aspect of human existence is going digital.
As we've learned more and more about these, they really go well with the concept of decentralizing.
We believe in democratizing finance for all. And together, we will continue to change Wall Street forever.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I am Danny Berger in London. You're looking at a very foggy London. Here's what's coming up on today's program. China drives market sentiment. The Hang Seng and CSI slump as Beijing cracks down on education companies. Traders are gearing up for more Fed-induced volatility. That's amid rising virus cases. The S&P 500 hit another record on Friday on strong corporate earnings, but futures this morning in the red. And Bitcoin surges. Short covering and reports of Amazon's involvement in the sector push the coin back towards $40,000. Well, it's a bull market that refuses to quit, but it certainly is getting tested this morning with the various headlines coming out of China, be it U.S. relations or the continued crackdown on tech. So let's get more into that top market story for us today with Juliet Sally. Juliet, good morning. Thanks for joining us. So China's widening clampdown, it really feels to be dominating not just Asia, but the global market session so far today. Just how painful has this been in Asian markets?
Yeah, absolutely, Danny. And in fact, we're just seeing TAL Education, New Oriental plunging in US pre-market as well. So really showing that what we've seen in Asia today is going to flow through into the US share market. This is this $100 billion online education tech sector, which has been a darling for investors, but certainly been this clampdown by authorities after they called for a hijack. Well, they said it was hijacked by capital and needs an overhaul, certainly weighing into overall sentiment. You're seeing the Hang Seng Index now closing down, dropping the most since May last year, erasing all of 2021's gains. It's now holding at its lowest level since December last year. But we saw this coming through across all the key indexes as well, particularly the Hang Seng Tech Index, which fell by as much as 7% today to July 2020 lows, and the CSI 300 also erasing all of this year's gains. This has led to a number of analysts scrambling to cut their price targets on the sector. You've got the likes of JP Morgan saying the worst case has become a reality. Citi reiterating its sell on a number of the key players, and Jefferies slashing its price targets too. As if we flip the board, we saw this huge pain coming through in a number of these education stocks today. We've also, as I mentioned, seen the Hang Seng China Tech Index, which had risen by about 59% since its inception almost a year ago. Tomorrow marks the 12-month anniversary of that index. Now wiped more than $551 billion of value due to this raft of clampdowns from Beijing. So that has actually reduced its gains for the year to less than 6% over the 12 months, down about 13% so far over the course of this year, and underperforming onshore peers like the Chinex, but as well as the NASDAQ. So this is just highlighting these regulatory risks for one of the fastest growing sectors of China's economy, and Danny, leading to questions as to what sector is going to be next and what this means in terms of President Xi trying to manage the overall Chinese economy. Danny.
Yeah, definitely very active in these markets. You're going to stay on top of it for us throughout the next few hours. Jules, thank you so much. That's Juliet Sally in Singapore. Now let's dig more into these markets and how you want to trade exactly around these various headlines. We're joined now by Caroline Simmons, UK CIO at UBS Global Wealth Management. Caroline, first off, thanks so much for joining us this morning. And I guess kind of the multi-trillion-dollar question right now in these markets is how much read across do the China tech crackdown have on the entirety of markets, or is it very idiosyncratic to these specific companies in China at the moment?
Yeah, so I think it's obviously an indication that as new sectors evolve, regulation catches up with them. And that is a feature, I suppose, that would be commonplace against all markets. But these issues that are going on specifically around the education sector, obviously this is specifically targeted to the Chinese stocks by the Chinese government. There will be some read across for US listings, but it's relatively isolated in that sense. I think what it does show us is that we have an opportunity to perhaps focus on other areas of tech growth for a change. Everyone has been very focused on Chinese tech for many years, and actually perhaps it's a chance for European tech to have a resurgence.
Oh, interesting. So do you continue to trade maybe not just the divergence of Europe tech and Asia tech, but U.S. tech and other emerging markets? Do you go in and focus now on those sorts of sectors?
Yeah, so I think you focus on the ones that have continued structural growth around them. So in Europe, for example, we would look for digital leaders. So, the first wave of digitization happened in, the communication space and social media platforms. Then it happened in the consumer space with e-commerce. Now it's about industry. So the Internet of Things and the growth of Internet of Things, particularly in Europe, because of the high level of industry, is an area that we think can continue to grow. Again, in the US, big cap tech is probably not going to outperform in the second half of the year. The product cycles aren't particularly favorable, and it already did well, obviously, last year during the pandemic. So again, to focus more on the areas of structural growth.
I wonder if this gives us a longer-term opportunity to focus on, as you say, these areas of structural growth. But I wonder if in the short term, the medium term, you worry about more volatility considering what's happening in China. I mean, just looking at what the markets are doing today, you're seeing small caps down pretty significantly. Both Europe and U.S. futures are more negative. Do you expect this to hit sentiment and more volatility to come just for now?
Yeah, I think it certainly will keep volatility elevated. Investors are used to volatility in the tech space. We do get regular corrections of over 10%, and tech, more often than not, 6 months later is up after those corrections. But it's a sign of where we are, with the increasing regulation in technology, with the potential changes from monetary policy as we go through the course of the year. We are expecting volatility to stay with us through markets. But the backdrop that we have of the strong growth and the strong earnings growth is likely to deliver upside to equity markets over the next 6 to 12 months, despite the fact we're probably going to have more volatility through that.
Do you worry about peak growth, not just globally, but China as well here, kind of to add on to some of the risks? Do you worry about that in your asset allocation strategy?
Yeah, so the peak growth argument is a very interesting one. Obviously, everyone was expecting growth to peak around the middle of this year. China peaked earlier because of the fact that they came through the pandemic quicker. In terms of implications, it does mean that we're taking some slightly more nuanced bets within our allocations. So we had very pure cyclical, pure value. Now we have a little bit more of a barbell approach where we do have still a preference for value because we do think the bond yields will go up, but we've also introduced areas, for example, like pricing power, which can start to give us companies that are likely to benefit from the inflation uptick.
So, Kailey, we'll definitely get more into some of your value calls in just a little bit. We have a lot more to go over, so you're going to stick around with us. That's Caroline Simmons from UBS Global Wealth Management who's going to stick around. Now, we're just talking to Juliet earlier, Juliet Sally, who's in Singapore, and these headlines certainly affecting her and anyone else in the country. Singapore to start opening their border in September, and that's on their 80% vaccination goal. We know some of the Asian countries perhaps weren't as ahead when it came to vaccines, more strict on various lockdowns. So Singapore looking at opening that border, obviously very important for the business climate as well, people coming in. Now, also some breaking lines out of Germany as well. We have their IFO survey of business confidence unexpectedly falling. The index coming in at 100.8. The prior was 101.8. So not only is it falling, it's also missing expectation. The expectation was for business confidence to improve to 102.5. So again, this is a surprise. Companies certainly concerned about not just supply shortages, but infections as well. So a double whammy hitting these numbers. And to go over these numbers, stay with us on Bloomberg Surveillance Early Edition. Later on in the program, we're going to be speaking to the IFO Institute president, Clemens Fuest. But next, we're going to turn to the U.S., the upcoming Fed meeting. We're going to discuss all of that with Caroline Simmons. And if you have any questions for our guest, IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, we continue to see further destruction when it comes to China stocks, specifically those listed in Hong Kong that are Chinese businesses. This is the HSCEI, the Hang Seng China Enterprise Index. It mostly consists of tech companies that are listed in Hong Kong entering a bear market, falling 24% from its peak, which was back in February. Should just point out that the second biggest market weight in this index is Meituan, the food delivery company, as China says online food platforms need to ensure deliverers' rights. So more coming out of China, cracking down on these tech-enabled type companies, sending this index into a bear market. Now, though, let's get over to the first word news. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Danny, and thank you. The UK has reported a drop in new coronavirus cases for a fifth consecutive day. Some 29,000 new infections were recorded on Sunday, down from more than 50,000 on the 17th of July. However, any impact from last week's removal of restrictions is yet to be reflected in all that data. Now, the top US infectious disease expert says the country is moving in the wrong direction and combating a new wave of COVID-19. Anthony Fauci says with half of the country still not fully vaccinated, the US faces a worst-case scenario of daily deaths reaching 4,000, the same level as during last winter's peak. China says relations with the US are in a stalemate. In a tense start to high-level talks in Tianjin, Vice Foreign Minister Xi Feng told visiting Deputy Secretary of State Wendy Sherman that some Americans seek to portray China as an imagined enemy. It is the highest-level face-to-face meeting between the two sides, and that's since March. Tunisia's president is reported to have fired the country's prime minister and frozen parliament over the government's handling of the pandemic. According to Sky News, Haitham Mechichi was removed after a weekend of protests, with Tunisia facing one of Africa's worst COVID outbreaks. Mechichi was sworn in a year ago amid deep political and economic turmoil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. That's Leanne Gerrans there. Now, I want to quickly look at what's happening in these markets so far, because we've been discussing how a lot of China, the Hang Seng China Enterprise Index, for example, entering a bear market. Well, we certainly are seeing a negative session play out. At least that's what futures are indicating. Taking the brunt of the beating is the Russell 2000 Futures Index, down by more than 8%. Outperforming, even though it is down, is the NASDAQ futures. This is something we saw on Friday. Even when we hit a new record, it was led by the big cap tech. So maybe even a little bit of concern as we continue to chart higher. And of course, those lower yields also pressuring the markets as well. Your US 10-year nominal yield at 122.45. Caroline Simmons from UBS Global Wealth Management is still with us. And Caroline, just before the break, you were talking about that you still want to go for those cyclicals, go for value. What is the catalyst that lifts those up, considering we continually see days like Friday and even today, whether the direction is up or down? It is those cyclicals that seem to take the brunt of the beating and the worry from investors.
Yeah, it's a combination of factors that supports them. One is the earnings growth. So, for example, in the UK, 90% of the earnings growth this year is coming from the value sectors. In terms of the earnings season already, most of the value sectors are showing very strong year-on-year earnings growth and also good earnings beats. We also have a very attractive valuation in the value space. Many sectors trading at or still below long-run averages. And then, of course, we have the potential for the bond yield to move higher. So, as we move through the economic growth, people get more comfortable with the rise of the Delta variant of COVID, and they see that actually global growth isn't being derailed by this, that it gives a scope for the bond yields to move a little bit higher, and that should also support value.
If we don't see bond yields move higher, I mean, we're certainly seeing them move lower this morning, down by about 5 basis points at 122. If we don't see them move higher, could we still see cyclicals and value outperform, or do they necessarily need a higher yield in order to get that pickup?
It's a very good question. It makes it harder for them to outperform if the yield doesn't rise. I think if the yield stays where it is, but they outperform on the earnings side, then they can outperform on the share price side. If bond yields fall, then I think it's quite hard for the value cyclicals to continue to outperform, even if their earnings dynamics are better.
And you know, within this market, one of the really remarkable things that we've seen is that last week, exactly a week ago on Monday, when we had markets selling off, they continue to get this bid. A lot of the anecdotal evidence out there points to maybe more of the retail sector. I know people hate to talk about cash on the sidelines, but it does feel like we have this effect that people want to put money to work in this market. Who is supporting this market at the moment as you see it? Is it that retail space that continues to prop it up?
I think it's anyone who's investing, really. When you look at the dynamics for the equity space, particularly if you compare it to the bond space, it looks very attractive. Most people see upside to the equity markets. And so, you know, any asset allocator, institutional retail, who can see that is likely to want to be, you know, part of it. So, you know, I think it's across the board. But obviously, the weight of money is still, you know, relatively small for the retail space. It's obviously higher in the US, but globally, the retail investor is still a very small percentage of overall investing.
Right, that's a very good point. Perhaps sometimes we get a little bit too excited about retail investors and the power behind them. Caroline, thank you so much for joining us this morning. That's Caroline Simmons, UK CIO at UBS Global Wealth Management. Now, I just want to point out again the latest IFO survey of business confidence coming out, missing estimates and falling from the prior reading at 100.8. The expectation was 102.5. We are seeing German stocks down, basically with the rest of the market down about 0.75%. So perhaps some sentiment leaking into the market as well when it comes to some of that pessimism on both virus case counts and the supply chain issues. And we're going to get more into that up next. We're going to be speaking to the IFO Institute president, that's Clemens Fuest, about their latest business climate report. And if you have any questions for him, IB plus TV Go, reach out to us. Let us know what you want answered. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Germany's IFO Business Climate Confidence Index unexpectedly fell. The closely monitored gauge came in at 100.8 points in July, compared with the 101.7 points registered in June. Not only that, but it also missed expectations. Now, the reading comes as Germany sees an increase in COVID infections on top of the supply woes. So we're joined now by IFO President Clemens Fuest. Clemens, thanks so much for joining us. So in terms of what caused this index to miss, what were the big surprises that we hadn't been accounting for in terms of expectations for confidence to rise?
Yes, the surprise was that companies are becoming a lot less optimistic for the coming months than they were. Companies are telling us, yes, the current business situation is strong, but we are expecting problems for the months to come. So there are some question marks really over the continuation of the recovery.
Do you have any sense to whether it's the virus case count picture that is more of an uncertainty, or if it's the supply chain? Because, you know, these are things that businesses have been dealing with now for quite a few months. Was one or the other more clear in terms of deterrent of optimism for businesses?
The most striking number is probably that in manufacturing, almost 2/3 of all companies are telling us they are experiencing supply problems. So problems with the provision of intermediate products. Things are getting more expensive, prices are rising, and some products are unavailable. And that is compared to an average in normal times of between 0 and 10% of companies telling us the record in the last 2 decades was 20%. So there are significant problems, and they are getting worse. They aren't getting better, as everybody, including ourselves, expected, I believe, during past weeks. Because 4 weeks ago, this share was only 45%. So there is a problem here.
What sort of impact do you expect that to have in the way businesses operate in terms of capital expenditures and hiring and those sorts of things?
What we see is that companies are currently depleting their inventory. At the same time, they are, they have filled order books, so there's a lot of demand. They are facing problems. They want to hire. They are facing problems finding skilled workers. And they are expecting problems to persist with this provision of intermediate goods. This depletion of inventory is not sustainable, obviously. So we are facing difficulties in the autumn. And companies will certainly react to that and maybe even cut back their capex or even hiring if they think these problems persist.
Right. It's certainly fascinating if they cut back, because to a large degree that led to some of the demand and supply mismatch issues we had. Clemens, thank you so much for joining us. I'm afraid that's all we have time for. That's Clemens Fuest, president of EFO. Now, coming up, we discuss Bitcoin surges amid short covering and speculation about Amazon's involvement. We're going to talk crypto as Bitcoin rallies more than 10%. This is Bloomberg. China drives market sentiment. The Hang Seng and CSI slump as Beijing cracks down on education companies. Traders are gearing up for more Fed-induced volatility amid rising virus cases. The S&P 500 hit another record on Friday on strong corporate earnings, but futures in the red this morning. And Bitcoin surges. Short covering and reports of Amazon's involvement in the sector push the coin back towards $40,000. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, where it's gone 9:30 a.m. And we certainly are seeing a more risk-off mood to these markets. It's a bull market, yes, but it certainly is being tested considering all the latest coming out of China. So let's get more into that in our top market stories with our MLive's Laura Cooper. Laura, thanks so much for being here. A very busy day in markets, a very busy week for markets. I mean, is it really just concentration on the China story? Is this going to have a major spillover effect into broader markets?
Well, I think certainly the price action this morning does suggest that sentiment is spooked by what we're seeing in China. But I really do think this remains largely an idiosyncratic story within China. The fact that the Hang Seng recorded its sharpest drop since 14 months ago, similar for China A shares, whereas what we're seeing in Europe looks relatively contained at this point. I do think, it's going to broadly be contained, but certainly an interesting start to the week.
Right. And, just seeing that U.S. 10-year real yields falling to a record, a negative 1.127. What is that being dictated by at this moment? Is this just this sort of general risk-off attitude that, as you say, will eventually play out to be more contained?
I think that certainly is the case. And I think, markets are looking towards that FOMC meeting on Wednesday. And I think expectations are quite low. The fact that they're not going to signal any kind of imminent tapering. And that's largely because we are seeing that spread of the Delta variant. We are seeing more market volatility. We are seeing growth expectations cool since June. So there's really not a lot of impetus for them to signal that at this point. So I do think that's why we are seeing real yields on the back foot.
I mean, how much of that is consensus at this moment, that there's not going to be a lot coming out of the Fed, their hands are tied? And sort of along with that, does that mean that there's a really big tail risk associated with the Fed meeting if expectations are, it'll be calm, no fireworks, nothing like that?
And I do think the risks are more asymmetrically skewed to being a hawkish surprise, because we are seeing those inflation prints come in stronger than expected. That's expected to be repeated in that core PCE deflator later this week. We are seeing anecdotes coming from earnings reports that companies are feeling these price pressures. But market expectations at this point are tilted more towards the Jackson Hole as really the event risk to watch, and unlikely to see much from the Fed this week. We are still seeing this divergence across members. So a clear consensus I wouldn't expect coming on Wednesday.
Okay, so I do have to ask you about the one asset then throughout all of this market sell-off is doing well. Of course, it's Bitcoin, trading above 38,000, up 11%. Do we have any read how much of this is technical short covering versus Amazon potentially looking at accepting cryptocurrency payments?
Well, it's a case of both of those, really, because we do have reports over the weekend that about 700 $700 million in those short positions were covered. That certainly is adding to that rally. But more broadly, it's coming from those supportive comments from Elon Musk. We had Cathie Wood as well. And this potential for Amazon to actually accept the cryptocurrency potentially on its platform later this year. That came after a job report, a job opening that they could potentially hire a digital currency product lead. But I think it'll be interesting to see what Amazon earnings hint at later this week around the crypto space and whether that can provide a next leg higher.
Yeah, it's so interesting because, a lot of Bitcoin and crypto proponents will say, okay, this is a great space to kind of hide out when the goings get rough as an inflation protection hedge. But even on a day like today, you could say, okay, perhaps it's outperforming, but of course it's very sentiment driven. I mean, what do you make of those arguments that Bitcoin can act as an ample hedge in your portfolio?
Well, I think actually I'm quite surprised by the price action today, because typically what we've seen is that Bitcoin tends to be a proxy for risk sentiment, and that's because of its a tie with those retail investors. So the fact that we are seeing it on the front foot today, despite the downbeat mood in markets, does suggest there are those technical fundamentals, technical factors at play. We did see the currency break above its 50-day moving average, which provides more upside. But I think at this point, I wouldn't say that this is a place to seek protection amidst inflationary fears or the fact that we could see a broader market sell-off.
Right, and those dip buyers, the retail dip buyers, out in full force. Vanda Research had some numbers out saying that in the market sell-off, that on Monday people went in, they bought it again. I talked to Caroline Simmons from UBS Wealth Management earlier, who said they don't have enough of a power to really do that. But does the presence of these perpetual dip buyers mean that there's a floor on how low equities can fall right now?
And well, I think that's exactly the case. And if we look at what happened last week, we saw such a sharp sell-off on Monday, but then just this fierce rally through the remainder of the week without really a clear catalyst does suggest just the force of those retail investors at the margin to buy the dip. And the fact that we do have this ample liquidity, there's really not a lot of downside catalyst for markets to grasp onto at this point. I do think that is helping propel equities higher. The fact that we did have U.S. equities close at record highs on Friday, despite that Monday sell-off, I think is quite telling.
Right, and finally here, Laura, I mean, how much volatility is the market geared up for in the week? We talked about all of the possible risk events, be it the FOMC or earnings. Is this the summer volatility about to rear its head?
Well, if there was a week for summer volatility to creep higher, it certainly would be this week. We have an exceptional week of earnings data. We have the FOMC. Now, the fact that, yes, the VIX volatility gauge does remain somewhat elevated, certainly not anywhere near the highs that we saw earlier this year. So I do think that, potentially a hawkish Fed. We have PCE deflator. We had GDP prints this week, earnings. There's so many things for markets to really grasp onto that could spur those bouts of volatility.
Right. Never a boring moment for you. I hope you're not planning to take off this month or next month, because we're going to need you here to comb through it, Laura. Laura, thank you so much. That's Bloomberg's Laura Cooper joining us and going over all of the market action we are expecting. Now, coming up, summer profit in sight. Ryanair sounds optimistic as easing restrictions spur a surge to flights to European beaches. More on our conversation with the CFO of Europe's biggest budget airline next. This is Bloomberg.
What happens in Spain is, I think, very, very important, very positive, which is that we don't find any kind of rejection from our population regarding vaccines. This week we reach 52% of our total population with that is fully vaccinated. We expect to before the end of the summer to have 70% of our population fully vaccinated. We are now starting to vaccinate the youth, because we focus in the beginning of this vaccination campaign, the people which ages, they are older and of course, most vulnerable to COVID. So, we are expecting a new phase in our fight against COVID, and thanks to vaccines and the vaccination campaign, and thanks mainly to our population, we are, speeding up day by day our vaccination campaign. So we're very positive and I'm very optimistic about, the situation that we will face regarding the COVID in September. One thing that I'm really proud of Spain is that during this last academic year, we kept open 99.5% of our classrooms. So this was something, incredible, because if we compare to other countries, unfortunately they had to lock schools, but we kept open our schools rooms by 99.5% during this last academic year, and I'm so proud of it.
Interesting. As a mother of four, that's really interesting to hear, and also appreciate your sharing the stats on the vaccination rates. That is impressive. We started with Apple, and I want to end there. You mentioned that Apple is investing in artificial intelligence in the country. I'm curious if you can share any more information about Apple's strategy in Spain. Of course, they've got a huge presence across Europe, but what more should we expect to see from Apple in your country?
Well, we expect to have an increased investment of Apple in Spain in the coming years in these two fields. First of all, artificial intelligence, and since we have this huge bet on converting Spain in a kind of a European audiovisual hub, to see Apple TV also, committed with my country, with Spain. But all the conversations that I had with the global companies that I had during this day, the insights and the feeling that I got is that they count on Spain. They see that Spain is a safe country with a good quality of life, and of course affordable and competitive in prices. So I think that we have a great opportunity for both for the Spanish government, for my country, and also for all these foreign investors and companies.
Spanish Prime Minister Pedro Sanchez there speaking to Bloomberg's Emily Chang. Now let's go back into these markets where we have a plummeting U.S. 10-year real yield hitting a record low of -1.127. Now it has bounced slightly off of those lows, currently at -1.1138. So yes, it has retrenched, pared some of those losses, but still a deeply negative real yield in a day that continues to see a negative sentiment sweep across markets, of course, starting with those China headlines. Let's see what else is going on in Bloomberg Business Flash News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Philips has announced a share buyback program worth as much as 1.5 billion euros after profit and sales rose in the second quarter. The Dutch maker of respiratory gear and body scanners is planning to buy back as much as 4% of stock over a 3-year period. Beginning this quarter, Philips has been making acquisitions to build out its telehealth and diagnostics portfolio.
We saw strong growth in the quarter, 9%, and a nice profit expansion. So Philips is delivering on its guidance, and we see a lot of customers signing up for long-term strategic partnerships because they believe in our strategy. They want to invest in telehealth, in informatics, and improving healthcare around the world.
Now, tobacco giant Philip Morris, the maker of Marlboro, is said to be planning to end all cigarette sales in the UK within the next decade. The Mail reports the CEO says the plan is part of a strategy to phase out traditional tobacco products and encourages switch to alternatives like e-cigarettes. The UK government has laid out a roadmap for Britain to go smoke-free by 2030. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you so much. Leanne Gerrans there here in London. Now, Ryanair aims to halt losses this fiscal year as the easing of coronavirus curbs spur a surge in summer flights to European beaches. The CFO of the region's biggest budget airline spoke to Bloomberg earlier.
We would anticipate that we will make some profits over the second quarter of this year. We're seeing a great resurgence in bookings since the EU digital COVID certificates have been rolled out. That's giving a lot of confidence, and we would anticipate that this will feed into the profit in the second quarter. I would like to see a little bit more confidence in the UK, and it's rumoured that France will go off the amber list onto the green list in the course of the next week or two. So I think confidence is rising in the United Kingdom. We now have 80% of the population vaccinated there. Europe has done a very good job in catching up, and again, huge resurgence in bookings over the past number of weeks, particularly as the EU digital COVID certificate has been rolled out.
How much of a capacity change and of a business change will it make to Ryanair if that changes and the UK accepts vaccines from outside of the NHS system?
It won't be a capacity issue for us, Manus. It'll be a higher load factor. So you'll see the load factor increase from the 73% that we had in the last quarter up into the 80s and hopefully towards the 90s, as I said, towards the back end of this year. We've got most of our capacity flying at this point in time, and we have it very well deployed across our European networks.
So Neil, when we look at this, where are your opportunities to expand now? And you say you're nimble enough to do so. So what has COVID done in terms of throwing up opportunities in places where you perhaps were not looking before that you are looking at now?
Oh, it's phenomenal, and the very fact as well that we've got the game changer aircraft coming in. We'll have 60 of those before the summer of next year, 210 over the next 4 to 5 years, is giving us massive opportunities. A lot of airports around Europe not only looking for growth but also looking for restoration of traffic where airlines have failed or they've pulled significant capacity out. And I think you can see that in the bases that we've already announced for this year, a number of new markets and indeed going into existing markets. Arlanda in Stockholm is a base that we've announced. That would have been traditionally Norwegian and SAS base, very hungry for our traffic up there now. We've gone into Billund in Denmark. We've increased capacity significantly in Helsinki. But at the same time, we're growing in Italy, where we're already the #1 carrier on the back of Alitalia and their issues. We've announced a new base in Turin. We've doubled our capacity in Fiumicino in Rome. We'd have expectations that we'll do a lot more in Portugal, again, where we're one of the largest carriers on the back of TAP pulling out capacity, and of course getting opportunities in Central and Eastern Europe as well with our new base in Riga, our airline Loud Emotion opening up bases down in Zagreb and Sadar. So lots of opportunities all across Europe, and we anticipate that we'll see more of those.
That was Ryanair CFO Neil Sorahan speaking to Bloomberg earlier. Everyone optimistic and hopeful that they will get their summer holiday. Now we're going to stick with corporate news, and Credit Suisse seeks to move past its string of recent scandals. The Swiss bank says it has settled its spying case with the former wealth chief Iqbal Khan. We're going to discuss that up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Credit Suisse calls to a close a spying scandal that rocked one of Europe's biggest lenders last year. The Swiss bank says it has reached a settlement with its former wealth management executive Iqbal Khan and a private detective firm. A spokesperson for Credit Suisse has said that all involved parties have agreed to settle, and this matter is now closed. Joining us is Bloomberg's managing editor for EMEA Finance, Michael Moore. Okay, Michael, they say that they've settled. The matter's now closed. What do we know about the settlement?
Not a ton of details, but they managed to avoid court in this matter, and you can see why all sides would want to do that. Iqbal Khan has moved on to UBS, where he's a prominent executive there. And this was a very embarrassing scandal for Credit Suisse. So I think all parties had incentive to kind of avoid more headlines on this.
Well, it's not the only scandal that it's faced in the past year. And of course, they also have their earnings coming up this week. How prominently is that going to feature when they give out their results? And of course, during investor and analyst calls as well?
Right. So there's certainly a lot of questions about, the compliance and risk controls at Credit Suisse. I mean, the con issue goes back, all the way to 2019 under Tidjane Thiam, who was forced out over this issue. The fact that they were spying on a former executive, they were indications were that the bank was concerned that he might poach talent, and that was the reason for it. But it certainly blew up into a huge scandal for them. And then they moved on to Thomas Gottstein, tried to enter calmer waters. They were trying to reset, but then ran into a number of issues over the past year, including the collapse of Greensill Capital and Archegos. So there's going to be a lot of questions about, how much is it going to cost to clean up all these issues, to settle all the legal side of things, and then, also going forward, how do they avoid some of these issues?
Right, all about costs, certainly. And look, it's not just Credit Suisse, of course, that's in focus this week. We have many other European banks also reporting. And at the same time, the ECB saying that it will lift its dividend cap. What should we expect from that announcement? Are we going to get some read through on earnings, what dividends and investor payouts might look like?
Yeah, I think all the banks had been anticipating this. You had heard them earlier in the year talk about wanting to do, resume payouts or do some special dividends in the second half of the year, given the capital they've built up over the last 18 months. And having that green light from the ECB gives them a little more freedom to talk about it this week, to give investors some idea of their plans. Profitability has bounced back pretty well in the first half of the year from what we've seen so far. So a lot of these banks have been building up capital, and the shares have done pretty well recently. They would like to continue that momentum by giving some of this capital back.
Right. And certainly something shareholders will be excited to see as well. Michael, thank you so much for joining us. That's Bloomberg's managing editor for EMEA Finance, Michael Moore. Now, quickly, let me just bring you where the U.S. 10-year real yield stands at this moment, because it had fallen to a record low, lower than a -1.12. It's given up some of those losses, paired slightly. We're at 1.1124, but still, it perhaps is not just the China concerns, it's growth concerns that's weighing on this market as we head into a busy week of earnings, of continued watching out on these China headlines, and of course an FOMC meeting that will certainly cause more volatility. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of New York alongside Kailey Leinz. We're going to continue this conversation and keep you on top of these markets. This is Bloomberg.
China is becoming a power that is much stronger on the geopolitical stage. And I think all of that regulatory crackdown, if you want, is shaping China for the next decade.
Xi Jinping clearly sees the role of the state, the role of the party to go around and clean up areas of business which he thinks are objectionable in some ways.
First of all, you have to admit that pretty much any government can become interventionists in the private sector if they choose to do so. In China, this has always been the case, so investors have always worried about regulation, about the stance of the government, and investing in China has been, partly inclusive of these concerns.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, July 26th. Our top stories today: China's incredibly shrinking private education sector, billions in market value, is wiped out as Beijing outlaws profits. China declares that relations with the U.S. are at a stalemate. High-level talks between the two countries get off to a rocky start. Nancy Pelosi says not so fast. The House Speaker says the bipartisan infrastructure bill won't get a vote until the Senate delivers a much larger Democrat-only plan. I'm Danny Berger in London with Matt Miller and Kailey Leinz, both in New York. Francine Lacqua is off this week. And it's a bull market that, for the most part, had been undeterred, with Friday hitting new records in the American equity market. But Kailey, futures pointing downwards, as certainly that bull market getting a big test today in the form of what's coming out of China.
Yeah, that China crackdown on education companies, Danny, making them, banning them from having profits, from going public, really is weighing on risk sentiment. We certainly saw this in the Asian session. There was one exception. Japan was higher after reopening after a holiday, but the Hang Seng in China and Chinese equities really underperformed, down 4% and 3% respectively. And the Hang Seng Tech Index was down about 6.5%. Of course, the big drags within that index were some of those education companies, the likes of New Oriental, which fell 41% in the Friday session, fell another 47% today. We're talking a decline of nearly 90% in just 2 days. And as that weighs on risk assets, investors seem to be looking for safety elsewhere, including in Chinese government bonds. That yield moving lower to 2.87% on the 10-year. And the Japanese yen is the big outperformer in the G10 space, stronger against the dollar by about 0.25%, sitting at 110.24. Here in the U.S., as Danny said, we are coming off of record highs that we saw at the end of last week, but futures are softer this morning, down about 18 points on S&P E-minis. You are seeing that bid coming into the bond market here in the U.S. as well, down about 4 basis points on the 10-year yield to 1.23%. And I wanted to point to the real yield as well, now sitting at negative 110 basis points, but it hit negative 112 earlier on in the session, which was a record low. So what are real yields telling us about the growth picture? And finally, I need to note Bitcoin as well at its highs, up 15% overnight, still up about 11% to $38,369. Matt, maybe we blame Amazon, or maybe we just blame short covering for that move.
Well, I think the Amazon story is really interesting. They're looking for somebody to run crypto there, and that sparks a lot of speculation about the possibility that Amazon will accept Bitcoin or perhaps some other crypto, and obviously that would drive the price much higher. Take a look at what's going on in terms of European equities. We are down across the board. This coming through from Asia, but they're not huge drops. 0.5%, 0.2%. The UK FTSE down just 0.4%. In terms of what's important to look at, I think the yields, first of all, I mean, they continue to fall lower and lower. Even though the arrow is green here because the price is rising, yields are coming down, so negative 43 basis points. The pound, very interesting, up today a little to 137.71, but the pound could have its first back-to-back monthly drop against the U.S. dollar in a couple of years now, and that is because there's a concern about the spread of the Delta variant and also because of the Brexit issues that are lingering. Ryanair, though, is a gainer today, and it's one of the biggest gainers on the Stock 600 because the airline is expected to post a profit in this quarter. It's doing really well as summer travel opens back up, as people start going to the beaches again in Europe. Even though there's a lot of fear around the spread of the Delta variant, remember that in terms of deaths, 99.5% of those cases are unvaccinated. In terms of hospitalizations, 97% of those cases are unvaccinated. So in terms of what vaccinated people can do, they can feel safe, they can travel. Apparently, Anthony Fauci thinks maybe they should wear a mask again. Not 100% sure why, but they're not really getting that sick, and so they can go places, and they are doing that, Danny.
And that is so important, Matt, not just for what's going to happen to Ryanair, but I think it's really fascinating for this supply picture, because if you think about it, if people can spend money on services, if they can travel, they're not going to maybe be buying motorcycles or cars or things like that. And maybe that will relieve some of the pressure that we're seeing on these manufacturers.
Right. I mean, there's still a few motorcycles that I want to buy, but I'm more into the classics, into the older stuff. There's not a lot of new bikes that I need. I'm sure for other people, though, you're right. They're going to be spending money on travel, on hotels, maybe going to the movies again, other services. I always think of getting a massage. I don't know why, because I'm not a massage person. Maybe mani-pedi. I like to get a mani-pedi. Maybe that's the kind of thing you're going to be doing more and more now.
Yeah, exactly. A mani-pedi, massages, all service stuff, all stuff you probably wouldn't want to do when COVID was at its height and you didn't have a vaccine. So we'll see how that factors into the data. And look, it is a busy week as to what's ahead. It's another big week for earnings, and that starts with Tesla today, which reports after the bell. We're also going to get some more tech giants with Apple and Alphabet follow with their results on Tuesday. And if that's not enough for you, the Fed rate decision comes Wednesday with a big focus on the pace of its bond buying program as we see bond volatility start to pick up and concern these markets. And then on Thursday, it's Amazon's second quarter numbers, and we'll also get a read on U.S. GDP. Now, that's the U.S. picture, but in these markets, it's been all about China so far this morning. It's the latest crackdown from Beijing, and China will overhaul the $100 billion tutoring and education technology industry, a sector it says has been hijacked by capital. Bloomberg's Juliet Sally joins us now from Singapore. Juliet, you've been all over these market moves. Just how negative of a reaction are we seeing in terms of investors digging through the latest moves out of the Chinese government?
Yeah, hey, Danny, it's been pretty negative. We know that this clampdown from China has been coming across a broad range of industries, specifically in the tech sector, and certainly online education tech hit very hard today as we had that reality, as you mentioned, that they are clamping down after calling for that hijacked by capital needing an overhaul. You saw the overall Hang Seng index drop the most since May last year. It's now erased 2021's gains, holding at December lows. The Hang Seng Tech Index has fallen by the most on record intraday, and it's holding at levels we haven't seen in a year, while in China, the CSI 300 erased all of this year's gains as well. All of this has also led analysts to scramble to cut their price targets on a number of the stocks and also in the sector as a whole. JP Morgan saying that this has basically been the worst case becoming a reality. They remain underweight on the sector, and Citi has reiterated its sell on a number of the key players. Kailey was mentioning some of the big names that were hit hard today. If we have a look at just how these price targets have been cut on this GTV chart, Jefferies also slashing price targets, saying that this could reduce competition and lend support to privatisation of companies. And Nomura saying as well that you would see a lot of foreign investment, Matt, just here on the sidelines.
You know, the interesting thing to me, Jules, is that the idea that since education is so expensive, especially because of these for-profit businesses, that hinders parents from having more than one child. And of course, the government wants to push them towards having 2 or possibly 3. So this is, in a sense, a program intended to help boost, reproduction. I think that's really fascinating. Nonetheless, it's the second kind of clampdown that we've seen after the fintech clampdown, now education. And so the question is, what's going to be next, if there is, because it looks like the Communist Party is really on the move here.
Yeah, absolutely. And we saw that happening with the food giant Meituan plunging the most on record in late trade. And this is after we heard that China could be clamping down on the food delivery service as well. We're hearing for rules here to try and ensure drivers' rights. So you saw Meituan closing down by almost 14% there. But this is all playing into the overall Hang Seng Tech Index as well, which was only set up a year ago. So tomorrow is actually the 1-year anniversary. But this crampdown that we've seen basically since the peak in February, when it had risen some 59%, has now wiped more than $550 billion off this index, seeing it underperform the peers, its own peers, the Chinex, and also the NASDAQ listed in the US, as this index continues to drop, now down by around 13% since the beginning of the year. One interesting point, Kailey, when we did see this weakness in the education sector, you saw a big spike in piano stocks, so people moving perhaps from online tutoring to playing the piano in afternoon trade, but certainly a big, tough day for Asian equity investors today. Kailey.
It is indeed. Thank you so much to Bloomberg's Juliet Sally. And keeping the conversation on China, but with a geopolitical angle this time, China lashed out at U.S. policies in a tense start to high-level talks, declaring the relationship between the world's 2 largest economies in a, quote, stalemate. Emily Wilkins, Bloomberg government congressional reporter, joins us now for more. So, Emily, a stalemate is maybe not as bad as further deterioration, but where does this relationship go next?
So we're going to be keeping a very close eye today on the second top diplomat from Washington, Wendy Sherman, as she goes to China. She's already had one meeting. She'll also be meeting with China's foreign minister a little bit later today. And we're keeping a close eye on what the tone of those meetings are. Remember, the last time that the U.S. and China officials met face-to-face in Alaska, the meeting was very acrimonious. There was a lot of tension there. The idea behind these talks that are going on right now is to keep lines of communication open between the U.S. and China and potentially pave the way for a meeting between President Biden and President Xi Jinping a little later around the time of the G20 summit.
So I'm more interested in terms of what's happening in Washington, Emily, in Pelosi's latest Sunday television show appearance, in which she basically said, we're not going to move forward with the compromise unless we first get everything else we want passed in the Senate. So how do Republicans feel about that?
Well, Republicans aren't super thrilled about this, but look, this isn't a new position. Pelosi has been saying this for a while, and she's been saying it because a number of progressive Democrats in the House have said, look, we're not going to be voting for this bipartisan infrastructure plan until we can vote with it alongside a larger reconciliation package. And that's their way of sort of putting pressure on the Senate and saying, hey, Senate Democrats, we need you guys to get that $3.5 trillion package together with things like childcare, things like education, potentially immigration, all that different stuff. Progressives believe that they really need that second package to go along with the first. Now, Republicans, they're not super thrilled about that. Even some Democrats who are more moderate say that they just need to move right now on that bipartisan infrastructure package, not wait for the $3.5 trillion plan. But at this point, Speaker Pelosi is holding firm, saying that the House will wait to vote on the bipartisan infrastructure until they get that second plan.
All right, well, all eyes certainly on Capitol Hill this week. Thank you so much to Emily Wilkins of Bloomberg Government, up early for us in Washington this morning. Now taking a look at some stocks moving in early hours here in the U.S. I want to begin with an upside mover because, you know, it's Monday morning. To start us off on a positive note, MicroStrategy up nearly 13% in early hours. Of course, this is a stock tied to Bitcoin, and with the boost we're seeing in Bitcoin, it is giving a lift to those shares. To the downside, though, one is Virgin Galactic. News over the weekend that one of the company's chief test pilot has left. He was really key in Richard Branson's own space flight earlier this month, so a bit of a blow to Virgin Galactic. Those shares down about 2.8% before the bell. And finally, as we were discussing with Juliet Sally, we are really seeing pressure coming for some of these Chinese education technology companies. We saw that playing out in the Asian session, but the U.S. listed ADRs under pressure as well, one being Gaotu, which is down 29.25% before the bell, Danny.
Kailey, on a day like this, when you see Bitcoin outperforming, you have to wonder if this, I know it's being driven by Amazon and perhaps covering is vindication for the Bitcoin bulls that, look, it is giving you protection in a very risk-off day. Well, we'll continue talking about that risk-off day. Up next, we have Geoff, BNY Mellon Senior Strategist for EMEA Markets, and later, Keyu Jin, London School of Economics Associate Professor of Economics. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Danny Berger is in London. Francine Lacqua is off this week. Now, I keep wanting to call this Bloomberg Surveillance China Edition because China plays so prevalently in the news today. But we're going to kind of pull that back to America this week as these gigantic companies start producing or publishing earnings, I should say. This is a really interesting chart. And as I show this, I'll welcome our listeners on London DAB digital radio. Clearly, you can't see this chart, but what it illustrates is that the valuation gap or the valuation premium for the largest cap U.S. companies has hit a 20-year high over the smallest cap U.S. companies. The explanation for this is really simple. I'm not sure if it's because they're gigantic or if they're gigantic because everybody wants to get in on Google, Facebook, Amazon. Well, Tesla, for example, is reporting later after the bell as well. So everyone is piled into these giant cap, mega cap companies. And Geoff Yu is with us right now, senior strategist for EMEA markets at BNY Mellon, to talk about, you know, earnings, Geoff, is going to really be front and center. We're going to have, I think, something like 25% of the S&P market cap is going to report this week. What do you make of these huge mega caps and their big valuation jump?
Well, if we look at tech specifically, to be frank, over the last few years, tech has become a bit of a safe haven. Gone are the days where markets, pay closer inquiry to or place closer attention to cash flows and earnings potential. It has become a question of stick with what's safe, and tech has been safe, and market cap has increased. They've become mega cap. It feeds into itself. It's a virtuous cycle or a vicious cycle, whichever way you want to look at it. But this premium that you're talking about, I still think that it's a sign of markets just sticking with what they're comfortable with, and I don't see that changing anytime soon.
So that's the U.S. tech side. What about the Chinese tech side, Geoff? When you see the crackdown taking place in China, does that make you want to rethink investing there?
I think globally, this has been a new case for questioning, or rather acknowledging, the regulatory risk when it comes to investing in China. No one doubts that education is a very large market in China, but I think the government is looking at the medium to longer term, especially with the demographics. They've brought in 3-child policy recently, so wondering what can they do to ease the burden on parents, on children, their physical, mental health, right? So this is esoteric, but again, for global investors, I think it should be a warning as well, that even though China wants to keep the lines of investment open, there are risks involved.
Yeah, I mean, how idiosyncratic is this? I mean, not just to China and tech, but Chinese markets. I mean, does this spill over and affect how you look at your global portfolio?
I wouldn't say in the shorter term, because from a global portfolio's point of view, asset allocation is actually still quite underweight China. So even though this side of the equation still is uncertain right now, over the medium to longer term, China is going to be the world's largest economy. That is certain. So you don't want that mismatch when China becomes the world's largest economy. And finally, in the in the latest 5-year plan, they stress they welcome international investment into China's capital markets to capture China's growth. It's just growing pains for the time being, and again, a lesson for international investors.
I think it's really interesting, Geoff, as a move to alleviate the pressure on parents and the pressure on kids as well. It makes more sense and less sense as a market control mechanism. Doesn't that mean if you see any drops in other markets as a result of this, it's a great opportunity to buy the dip?
I think from the point of view of Chinese education per se, there are aspects of it which will be difficult to change. China's had a testing regime since the dawn of civilization, right? When you had the stories of how the pauper, the farmer's child, could test his way up to the right-hand side of the emperor, right? That has been the ultimate cause of social mobility, and it will always be like that. It's been like that for thousands of years, so there'll always be that market. It's just a question of how to capture it. Is it going to be through private placements? Is it going to be through direct investment? That may not be something that China would not welcome, so something to look at. With respect of platform companies, internet companies, again, growing pains, concerns about monopolies, and I think that's what the government wants to look at. Are they abused? Are certain companies abusing their monopolistic or oligopolistic position? So that needs to come into play as well. Again, growing pains, painful, expensive sometimes, but long-term asset allocation, I still think it's going to favor China.
All right, thank you so much for your time today. That's Geoff Yu, senior strategist for EMEA markets at BNY Mellon. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Now let's get the first word news. And the White House is looking to shift the way it talks about inflation. Republicans are trying to use the issue to kill President Biden's plans to spend trillions on social and infrastructure projects. Democrats plan to have the president use plain language explanations and assure people price hikes will fade in time. In the UK, the number of new coronavirus cases has dropped for the 5th day in a row. That's a potential boost for Prime Minister Boris Johnson following a chaotic week since the lifting of pandemic restrictions. Johnson's government has dropped social distancing rules and done away with mandatory mask wearing. And NBC saw a huge decline in the viewership for the opening ceremonies of the Olympics. Friday's event drew about 17 million viewers, including people who streamed it digitally. That's down about 36% from the opening ceremony in Rio 5 years ago. And coming up next, Keyu, London School of Economics Associate Professor, will be joining us to talk all things China, geopolitics as it relates to the relationship with the U.S., as well as the crackdown on education technology companies. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. And there are certainly many opportunities for markets to get a jolt of volatility, be it the China headlines after coming off all-time highs. But Matt, I think the European picture is fascinating today with Germany's IFO survey of business confidence coming out not just missing expectations, but falling from the prior reading. And it's not the current business climate they're worried about, it's the future climate, which means that the spending picture and hiring picture, that comes into question.
Well, and especially when you consider what's yet to come in terms of European and specifically German data, right? We get inflation out, and we're expecting to see huge numbers there as well because of the base effects from a tax cut to ease the COVID pain. Now, Germans are notoriously unhappy about inflation, and that still is true today. So when you see that, it could be a double jolt. Plus, you've got the GDP numbers coming out on Friday across, well, at least in the core of Europe, we're going to get the GDP readings on Friday. And so we're going to see, if we get higher inflation and the growth isn't as strong, that's a real problem for European markets, which have been doing quite well this year.
Yeah, and look, this has been a really big problem with the supply-demand mismatch. That part of the reason that the supply hasn't been there is because these corporations, these manufacturers, didn't want to spend up thinking that the demand wouldn't be there. So if they're worried now, that could certainly impact things. But Kailey, of course, it's not just European markets under pressure this morning. It seems to be the global market picture moving into risk off.
Yeah, and it really did start in the Asian session, Danny, with China's crackdown on education technology companies, meaning that they can't take any profits, they can't go public, and they can't raise foreign capital. That weighed on risk sentiment there, and that really is following through into the other regions of the world. We are seeing that in Europe, though we are off session highs. We're down by about 0.4% or so on the stock 600. And here in the U.S., after closing at record highs on Friday, we do look set for a lower open in about 4 hours' time, with futures down about 0.3%. You are seeing some safe haven seeking in the bond market. We're down about 3.5 basis points or so on the 10-year yield. 124 is where we sit. Will the Fed on Wednesday change the trajectory for the Treasury market? And then, of course, we're also watching Bitcoin up 15% at the highs, still up around 11% to $38,000 on speculation that Amazon may be getting into the crypto business, but also there may be some serious short covering going on. Whatever the reason, that lift in Bitcoin is lifting Bitcoin-related equities in early hours. Riot Blockchain up 19%, Coinbase, the exchange, up 6% as well. Plunging to the downside, though, are some of those Chinese technology companies. The ADRs in early hours here in the U.S. are under immense pressure. New Oriental down 23%, and Gaotu is down the better part of 30%, Danny.
Let's stick with China, Kailey. And China lashing out at U.S. policies in a tense start to high-level talks. The country said U.S. ties are in stalemate. Now, ahead of those talks, China's Foreign Minister Wang Yi issued a warning to the U.S.
The U.S. has been using its strength to put pressure on other countries and thinking it's superior to others. We need to tell the U.S. clearly, there is no country in the world that is superior than others, and there shouldn't be one. China will never accept any country that claims to be superior than others. If the U.S. has not learned to treat other countries equally, China and the international community have the responsibility to help the U.S. learn this lesson properly.
Joining us now to get into this is Keyu Jin, Associate Professor of Economics at the London School of Economics. Keyu, thank you so much for joining us today. Just how far have relationships plummeted between the U.S. and China?
Well, it's certainly going in one direction, that's for sure. But I want to say that we need to distinguish between a war of words and a war of deeds. It's important to understand that there are different layers of how China sees the U.S. and China-U.S. relations, at least from the Chinese point of view, the top leadership, which is really about preserving the harmony and fostering good relationship between the Biden administration, and then the working level at the foreign ministry and the general public. They are all very different things.
You know, we have one of the issues is trade has been a problem, or at least in the eyes of some, trade has been a problem because the U.S. Buys so much less stuff or buys so much more stuff than it sells to China. And I'm just looking at this chart last week. I'm sure you're familiar with it. We see trade, the surplus that China has going from a low in 2002 to a high in 2021. And it, with the exception of the COVID blip, it hasn't really stopped climbing. How do you view this? How does China view this? And is it possible to turn it around?
Well, this just demonstrates that all of the economists prior that the tariff war is not going to reduce the U.S. trade balance deficit has proven to be right. You know, China's still in the position where it just produces much more than it consumes. And whether the exchange rate changes or tariff wars or trade policies, that's just not going to change the fundamental aspect of savings and relationship, which is a macro issue. Consumption has been weak because demand has been weak. Even though China has recovered first, we're seeing a slowing down of recovery economic growth. And there's a really lack of demand issues, and people are having precautionary saving for a variety of uncertainty reasons.
Professor, does this change as the Chinese economy grows, as Chinese workers are paid more, as U.S. manufacturers and European manufacturers perhaps look into Asia ex-China for more production?
I think we were going in the right direction, you know, in the last few years. China's consumption is increasing. There are lots of policies that's encouraging households' consumption. And, you know, Chinese young generation like to spend. They even like to borrow. The generational shift is absolutely stunning. A big contrast with the older generations. But of course, the pandemic hit and people are very uncertain of the future, geopolitical tensions, and we're just, you know, the whole country is slowing down. But I think when the world really recovers, and who knows when that's going to be, the consumption story is definitely going to be the story of the day.
You talk about China slowing down. Do you think that slowdown has been over-exaggerated, and what would that mean for the PBOC?
I think the slowdown is real. We see, you know, a slowing marginal effect of investment. We're seeing contracted fiscal spending, also because China has to balance the financial risks with economic growth. And because of the pandemic, there's a huge amount of credit and debt issues that's surrounding companies, private firms, SOEs alike. I mean, these are real big issues. But I think China will use monetary policy, monetary expansion, while being a little bit more constrained on the fiscal side to balance that off. But the economic slowdown is both for structural reasons and cyclical reasons.
And does the crackdown we're seeing for some of these technology companies, obviously education technology companies, the latest, exacerbate that slowdown, lead to a lack of investment into Chinese assets?
I don't think we're going to see an immediate effect. I do not think that this crackdown will kind of mitigate the dynamism in the Chinese technology sector and the entrepreneurial spirit. Look, you don't really have to be China's richest man to be very, very rich and with a very successful technology companies. And for sure, the entrepreneurial spirit is still there. I think we need to make a more nuanced distinction between sensitivity and security data spillover kind of technology companies with the rest. Don't forget, there's only one way for China to continue growth, which is innovation and technology. And with the recent backdrop, it's going to have to do it on its own rather than through importation.
Kailey there mentioned the flow into China assets. I'm wondering what happens to foreign inflows and how sticky they are, considering we've seen more benchmarks introduce Chinese assets. Do flows necessarily stay in China despite of what's happening because of these passive type instruments investing in China?
Well, it's first of all important to say that Chinese government is totally committed to the financial sector opening up and liberalization as a one directional thing. It will be good for the Chinese financial system itself. It will be good for competition. And I think the government is committed to doing that. I think that China is going to be a country with lots of uncertainty, lots of shocks, reform shocks, monetary fiscal policy shocks, all kinds of policy directional shocks. And so it's going to be but I think a large part of it is still going to stay in China, longer term investment, trying to really get into the Chinese financial markets because there's huge demand for asset allocation, asset management, insurance, et cetera, which Chinese domestic companies are not able to fully offer these services.
All right, Professor, thanks very much for joining us. Pleasure having you live from Beijing. Keyu Jin there, Associate Professor at the London School of Economics. Coming up, Bitcoin is surging back towards $40,000. We'll discuss that and what to watch next. Plus, we're joined by Surveillance co-creator Tom Keene. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, Council on Foreign Relations President Richard Haass. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Matt Miller and Kailey Leinz, both in New York. Francine Lacqua is off this week. Now, Bitcoin's climbing the most in 2 months today. This is partially due to ongoing speculation over Amazon's potential involvement in the cryptocurrency sector. Now, meanwhile, gold, the digital Bitcoin equivalent, if you will, gold steadying as investors wait for the Fed meeting this week.
Gold is analog Bitcoin.
Yeah, exactly. I'm just reversing it, on a day where Bitcoin's doing well, why not? Well, let's get more on this with Bloomberg's Laura Cooper. Laura, do we have any sense to what's driving this more, be it the short covering from some of the shorts, of course, in Bitcoin versus the Amazon news?
Well, I think the catalyst ultimately was that Amazon news on Saturday, and that was just being further supported by comments that we've had from Elon Musk. We also had Cathie Wood. And then I think really the short covering is largely a story around this hour of trading that we saw earlier today, because we saw about 700 million in those short positions unwind over that period in quite heavy volumes. And that really sparked a notable increase. And we're starting to see it steady today since then amid this kind of broader risk-off sentiment.
Gold, the analog Bitcoin, as Danny put it there, started the year off at almost 2,000. It was like 1950. And even though we're up a little today at 1808, it could be the biggest annual drop, or at least on track for that, since 2015. While we're worried about inflation, why is the possibility of the Fed getting more hawkish just so bad for gold?
Well, I think certainly the fact that real yields are testing those record lows is somewhat surprising, the fact that how we're seeing in gold. But I think it's quite interesting, actually, that gold is on track for its largest drop since 2015. But the actually driver behind that is gold ETFs. We are actually seeing a strong outflow from those. And that is really driving that price action, less around those fundamentals, typically what you would expect amid this inflationary backdrop. So I think it's certainly something to watch. But I struggle to see what the catalyst could be to propel gold higher amid this backdrop.
Are either gold or Bitcoin looking correlated to broader risk appetite right now, Laura?
Well, certainly the price action today suggests that Bitcoin is not following through on what we would typically expect for that cryptocurrency to come under pressure amid this broader risk-off sentiment. And that's because it is being supported by those kind of idiosyncratic factors around the fact that Amazon could potentially accept it later this year. But I would expect that, we could see that further come under pressure because broader risk sentiment is taking its cues from the fact that the U.S. could be facing peak growth right now. So that's really the dominating force, I think, for markets at this juncture.
And Laura, do we have any idea of how much similarity there is in someone who's going to be trading Bitcoin and some of these broader type assets? Is it institutionalized enough that it should trade according to what the broader market is doing?
Well, I think that should be the case at this point. The fact that over the past year or so, we have seen just the demand for Bitcoin broaden out beyond just those kind of retail investors. So I do think that this is a trend that's going to stay. I think that's why we aren't seeing the type of drawdown in cryptocurrencies that we have seen in previous sell-offs, notably around that 80% mark. Yes, Bitcoin remains well below that $65,000 peak that we saw earlier this year. But, I do think there are still those fundamental supports in play. Notably, if we get clues from Amazon later this week in their earnings that, yes, they are confirming that they could accept cryptocurrency on their online platform. That's a game changer.
I'll tell you what, as the equity market was rallying last week and Bitcoin was selling off, one analyst suggested that the kids were liquidating Bitcoin positions to buy the dip that we had seen on Monday. So, Laura, thanks very much for joining us. Bloomberg MLive's Laura Cooper talking to us about what's going on in the markets. Coming up, Lucid Motors, highly anticipated IPO. Is it an IPO set for today? I guess the SPAC merger will be completed. We're going to speak with the company's CEO, Peter Rawlinson. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
We're bringing on the new factories, which are yet to be depreciated, and that's a normal cycle in the business as we bring on, the 10 and then 7 nanometer costs at scale. So it's very typical as we go through that, and then they build up in the longer term. So overall, we feel comfortable with the margin profile for the business to return to levels that the industry would expect. This is very normal cycles. But I'd also say, hey, we are investing for long-term leadership, and we're not apologetic about that. We are committed to be a growth company that is leading in technology, and between R&D, capital, we're going to make those investments to have that occur. We have an analyst session at the end of the year where we're going to lay out that multi-year picture to the marketplace more clearly. But overall, we're not concerned about Q3 margins. We're being more competitive. The products are being well accepted by our customers, and we are exactly on the strategy that I've laid out.
Now, I want to talk about the chip shortage. You said it hits bottom this year, but it'll linger for a couple of years. And I wonder how much that is adding to your optimism about the foundry business and taking on TSMC.
Well, it certainly is a factor, Emily, because right now, everybody, what do you got? Can you run more wafers for me? There is this clear search for supply in the industry, which is a bit of a tailwind. There's also very few companies that can do leading edge technology. So, they're looking at us quite aggressively that way. Also, this rapid buildup of new capacity, it takes time. And building a new fab from scratch is a 3 to 4 year exercise to have it built. So all of that view of a cycle of significant demand, and as I've said, I think we're in for a decade of good semiconductor industry characteristics because every aspect of human existence is going digital. Everything digital needs semiconductors. So as you look underneath that, this is going to be a good cycle for semiconductors.
That was Intel CEO Pat Gelsinger speaking with Bloomberg's Emily Chang last week after the company reported second quarter earnings. Well, it's time now to talk to Tom Keene. He, of course, is co-anchor of Bloomberg Surveillance. Joining us now, Tom, it's all about the markets for you and I today. On the one hand, you have what's happening in China. The other hand, you have real yields, the 10-year dropping to negative 112 basis points, a record low earlier today.
Markets are beneath the radar. They should not be, Kailey. We've got a busy week, the Fed meeting, the tech earnings, and all that. What we heard from the spin from Intel moments ago. The markets are screaming. The 5-year real yield has just popped down to, I believe, a record low. The 10-year yield is right on the cusp of it as well. The chart today is the 5-year inflation-adjusted yield with a very competent regression back a solid 20 years. This is an extraordinary chart, and it signals now breaking down to a new low. Mr. Summers is waking up and going stagflation.
Why the disconnect, Tom, when you look at, equity markets? We were up 2% last week. The S&P 500 is up 17.5% this year to date to an all-time high, and yet we're seeing these incredibly low negative real yields.
Matt, Michael Darter was taking a gin and tonic in Edgartown, I believe, this weekend, and he wrote a very thoughtful note over the said beverage about where are we and what's really going on. And he mentions that the discount rate is lowering. We are modeling in equity dynamics at a much lower yield point. Flip the fraction, and that's a much higher multiple, whichever multiple you're looking at.
All right, we look forward to your coverage throughout the rest of the morning. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And he'll, of course, be joined with Lisa Abramowitz and Jonathan Farrow by Paul Romer, of course.
The team is back together.
The team is back together. Lisa, back from vacation. She took like half the month of July off, but good for her. Now take a look at what else we are watching. And Matt, you are watching mask mandates.
Yeah, we're hearing more now about, I think, Dr. Fauci is talking about it, and a former Surgeon General is talking about the fact that vaccinated people may have to wear masks again. I'm sure they're being driven purely by the science, and what we know is that of the deaths that we've seen from COVID, 99.5% are unvaccinated people. Of the hospitalizations that we see from COVID, 97% are unvaccinated people. And although we know from asking a million times over the past year, you can still transmit the virus, even if you're fully vaccinated, the chances are those who are fully vaccinated aren't going to get it very bad. And if you pass it on to a kid, the kid's very likely going to be okay, because the science tells us kids aren't really that affected by COVID, at least not in the short term. So it's going to be interesting to me to see if people have to start wearing masks, even though they're fully vaccinated. And I'm really looking forward to hearing why as well.
Yeah, I mean, some of the preliminary noise we've heard from it is to protect people who aren't vaccinated, that if you are vaccinated, you can catch it and you don't want to pass it on, so wear a mask. I mean, it will be very interesting to see how that conversation develops. I am watching Tesla earnings that are out today after the bell in the U.S. I mean, Tesla kind of captures a lot of the market themes we've been talking about today, be it China. That's going to be a really, really closely watched sector of what they say in their earnings, of whether the Chinese business trends are positive for them. And of course, any updates on Bitcoin as well. Elon Musk has been talking very positively about it. Tesla owns it. SpaceX owns it. So that's, two very big topics that people are going to care about, Kailey.
All right, Danny. Well, I'm watching the markets. I'm also watching Capitol Hill and infrastructure talks in the Senate. We still do not at this point have a deal on that $579 billion bipartisan plan, but they are hoping to have it ironed out by early this week, maybe even today, so they can put it back up for a vote before that August recess, which is looming. Of course, if a deal is announced today, it still needs 60 votes to get through the Senate, so there remain question marks, but we'll see if agreement is indeed reached today. More Bloomberg Surveillance is ahead. Stay with us. This is Bloomberg.